The following presentation was recorded in conjunction with CSB Bancorp's April 29, 2020 annual meeting of shareholders. We regret that this year's annual meeting could not take place in its usual manner because of the COVID-19 crisis, but we are committed to doing our part in helping to protect the health and safety of customers, employees, and shareholders. We hope that you find this content to be of value, and we invite you to contact us with any questions or concerns. During the next half hour, I will discuss CSB's stock performance, financial highlights from 2019, and a brief look into our plans for 2020. We will also review CSB's response to the COVID-19 outbreak, along with current economic and banking industry conditions. The presentation will wrap up with a review of our continuing commitment to the communities we serve and the foundational mission and values that drive our efforts. Over the course of the presentation, I may discuss plans and objectives for future operations or future performance. Any forward-looking statements that I make herein or in future reports and statements are not guarantees of future performance, and actual results may differ. CSB's primary market area consists of Holmes, Tuscarawas, Stark, and Wayne counties in Ohio. We ended 2019 with 15 banking centers, including our main operations office. In January this year, we opened a 16th banking center in Bolivar, increasing our presence in Tuscarawas County to 4 locations. We will talk more about the Bolivar location later in the presentation. CSB ended 2019 with $684 million in deposits outstanding, $552 million in gross loans, and $819 million in total assets. Operating revenue totaled $34 million. The large majority of deposit and loan balances are from customers in our 4-county primary market area. As we review the excellent results of the past year, please understand that they reflect the diligent efforts of the entire CSB team as we strive to build a community bank of enduring greatness. Shareholders' equity surpassed $85 million in 2019, increasing by 12% or almost $9 million during the year. Dividends amounted to $1.08 per share, a 10% increase over 2018. Total shareholder return on CSB stock exceeded 9% in 2019, including market price appreciation and reinvestment of dividends. Total stock return over the past 3, 5, and 10-year periods respectively amounted to 44%, 114%, and 282%, again including reinvestment of dividends. Tangible book value per share has been steadily increasing as well and grew by 12.6% in 2019. Likewise, book value per share increased 11.7% in the last year. These results delivered solid value for our shareholders. Total assets, loans, deposits, and shareholders' equity all reached record highs in 2019, as did revenue. And net income surpassed $10 million for the first time in the bank's history. Each of these categories has exhibited steady growth over the past 4 years. On this slide, you can see that loan growth softened in 2019. As the year progressed, we experienced unusually high levels of commercial loan payoffs and paydowns. This was partially due to some customers having strong financial performance, which reduced their borrowing needs. In other cases, it was caused by a very competitive lending environment. In addition, our commercial loan demand was not as robust as it had been in the prior 2 years. Some manufacturing activity slowed from the impact of trade policies, and Along with other uncertainties, business owners' forward-looking outlook caused more caution when it came to borrowing money in 2019. On the other hand, fixed 30-year mortgage rates fell throughout much of the year, ending very near 50-year lows and fueling one of the best years of mortgage originations in the past decade. All told, gross loan balances finished about $2 million above year-end 2018. Deposit balances increased consistently throughout the year, partly due to business owners' caution about capital spending. We strive to maintain competitive rates on deposit products to attract and retain funds as we manage interest expense. All told, deposit balances grew 13% during 2019. This growth provided CSB with an excellent liquidity position, augmenting our ability to strongly support borrowers needing payment deferrals or funding of SBA emergency business loans as the COVID-19 crisis emerged. We will discuss this in more detail later in the presentation. Total assets increased 12% from the prior year end, and the bank is 26% larger than 4 years ago at the end of 2015. Operating revenue, defined as net interest income on a fully taxable basis plus non-interest income, totaled $34 million in 2019, an increase of $2 million over 2018. An efficiency ratio of 58% contributed to our strong performance. As a reminder, this metric reflects the bank's operating expenses as a percent of revenue. In other words, how much cost we incur to make a dollar of revenue. Our intentional focus on process improvement and enhanced technology over the past 5 years has allowed us to improve the efficiency of our teams, contributing to improved profitability and expanded capabilities. Full-year net interest margin declined slightly from 3.98% to 3.97% in 2019. Early in the year, margins were expanding on the heels of the rising interest rate environment from the prior 2 years, but then declined in the last half of 2019 as the Federal Open Market Committee cut interest rates 3 times. All of the above factors contributed to higher pre-tax return on average assets, or pre-tax ROA. Our pre-tax return on assets has climbed from 1.49% in both 2016 and 2017 to 1.63% in 2018 and 1.69% for 2019. As we discussed last year, the Tax Cut and Jobs Act, known as TCJA, was enacted at the end of 2017 and significantly lowered the company's effective income tax rate from about 31% in 2017 to a little over 19% for the past 2 years. The impact of the lower effective tax rate increased the company's net income by approximately $1.3 million in 2018 and $1.4 million in 2019, as compared to what it would have been under the previously higher effective tax rate. We strive to ensure that we are performing in the top 1/3 of all publicly traded Ohio banks with respect to return on average assets, or ROA, and return on average equity, ROE. ROA is commonly used to measure the bank's overall effectiveness in deploying the company's assets and amounted to 1.36% in 2019, up from 1.31% in the prior year. ROE measures how many dollars of profit are generated for each dollar of shareholders' equity, and ROE amounted to 12.77% in 2019. Looking at 2019's operational accomplishments, we completed a major 2-year restructuring of our information technology, or IT, infrastructure. We now have multiple off-site backups for our data systems, and the ability to fully restore IT operations within minutes in the event of system failure. The new infrastructure also provides scalability for company growth and enhanced digital security and dependability. Similarly, we have added to our IT staff, and we will continue to do so as we move at the pace of change in business and digital innovation. In fact, we currently have a team working on several enhancements to our digital platforms, which we expect to roll out to customers later this year. These enhancements are even more important now as the COVID-19 outbreak is limiting in-person interactions. We are proud to be recognized by ERC as one of Northeast Ohio's 99 best places for top talent to work. 2019 was the third consecutive year CSB has won this award. We continue to invite top talent to join CSB, and we firmly believe our dedicated team will continue to challenge the status quo and strive to build a community bank of enduring greatness. Switching now to a few comments on facilities and our core markets, in June 2019, we opened our newly constructed banking center in downtown Worcester. We've had a presence in Worcester since 2005 and have been operating 2 banking centers there for the past 8 years. Still, the positive response to our investment in downtown Worcester has been remarkable from customers and the community at large. The new facility offers a progressive banking experience with a contemporary layout optimized for smooth and efficient interactions, and a modern industrial look to match the redevelopment trend of the surrounding area. The new location also features expanded drive-through service and provides plenty of room to grow. In November 2019, we signed a lease to open a banking center in Bolivar, a northern Tuscarawas County community adjacent to Interstate 77. Our newest location is in a building that has been a bank branch for over 30 years, but was recently vacated by the prior tenant. A dedicated team of CSB employees worked tirelessly to refurbish the interior, much to the delight of local residents, and the banking center opened in January 2020. The Bolivar-Zoar community has a combined population of 5,000 residents, and we expect this new location to deepen our penetration and allow us to better serve the communities in northern Tuscarawas and southern Stark counties. Shifting now to the results of first quarter 2020, net interest income of $6.9 million was down a little more than 1% from the first quarter of 2019. Non-interest income was up 10% from the year-ago quarter, while other expenses increased a little under 5%. Net income for the quarter amounted to $2.48 million, a 2.2% decline from the prior year first quarter. At the end of first quarter 2020, the balance sheet is 10% larger than year-ago levels, with total deposits and shareholders' equity both up about 11% from first quarter in 2019. It is worth noting that the March 31 balance sheet is about 1% smaller than it was at December 31, as economic activity slowed markedly in our region during the last 10 days of March due to the escalating COVID crisis and stay-at-home orders. We expect net interest margin, which declined 6 basis points during the quarter, to contract further in coming quarters as the Fed sharply cut managed interest rates in March to nearly zero in reaction to the COVID-driven contraction in the economy. CSB's first quarter cash dividend was paid on April 21st at 28 cents per share. We will now turn to some observations on the economy. For context, as Americans rang in the new year, the economy seemed poised for continued growth. The U.S. economy had expanded about 2.3% in 2019 and appeared to be on fairly firm ground. In February, U.S. stock markets hit all-time highs. Interest rates were low, with prime rate having declined 3 times from August through October 2019, and fixed mortgage rates were in the low to mid 3% range, supporting borrower refinance and purchase activities. Consumer spending had grown in the mid 2% range and outpaced price increases during 2019. Measures of consumer and business sentiments on the economy were fairly positive on the whole. Employment levels also remained strong at the start of the year. However, financial markets became quite volatile after the coronavirus came ashore, and the unemployment picture began to change. What had seemed to be the major headlines of the day, globalization, trade spats, and political friction, were soon to be sidelined, at least for a while. COVID's global spread was monitored by the whole world, and its growth statistics have been startling. The first known case in the U.S. was identified on January 22. As of April 28, there have been more than 1 million cases and 58,000 deaths in the U.S. Ohio's first case occurred on March 9. By April 28, Ohio recorded 16,769 cases and 799 deaths. And in CSB's 4-county primary market, 506 cases and 60 deaths have been confirmed. Each day, new cases and deaths continue to be reported at this time. In addition to the tragic impact on human health, damage to the economy has been startling as well. In what the International Monetary Fund has termed the Great Lockdown, federal and state governments around the globe issued wide-ranging health directives of varying degrees, but generally restricting most people to stay-at-home orders for all non-essential travel. These health-ordered shutdowns have been pervasive. According to Moody's, 8 in 10 U.S. counties were under lockdown already on April 5. Those counties represent 96% of national economic output. The shutdowns have taken at least 25% of the entire U.S. economy offline. Current estimates are 29%. Those numbers are eerily similar to the 26% reduction the U.S. economy endured during the Great Depression. The magnitude and speed of collapse in activity that has followed is unlike anything experienced in our lifetimes. While the Great Recession was caused by a housing bubble and financial market excesses, this crisis is caused by a microbe, not an economic bubble, and there remains substantial uncertainty about the short-term and long-term impact on people's lives. In the U.S., it took only a matter of about a month for an almost unimaginable pullback in economic activity to occur. In the 5 weeks ended April 23, 26 million Americans filed new unemployment claims. That amounts to literally 1 out of every 6 working Americans. Ohio's numbers are roughly the same. 1 million Ohioans filed new unemployment claims in the same 5-week period, out of a total Ohio civilian workforce of 5.8 million people. Financial markets reacted with forceful declines. In a record short 30 days, stock markets dropped a full 30%. The crash was primarily COVID-driven, but it was bolstered by a simultaneous glut in oil supply, with Russia, the Middle East, and to some extent the U.S. all engaging in a game of chicken. The whole quick saga was excruciatingly difficult to watch. This afternoon, first quarter 2020 GDP was released, down 4.8%, and that was based on contraction that occurred largely during March. As we move through the next 2 quarters, this contraction is going to grow into the most severe economic recession of our lifetimes. All in all, second quarter U.S. and Ohio unemployment is trending above 15%, and total economic activity could decline another 20%. During this crisis, consumption patterns have changed, as shown by this slide of several consumer purchase categories. Once the crisis is over, there will clearly be some return to normalcy for many of the consumer items, but other consumer behavior patterns may have changed for the long term. The disruption in product pipelines, employment issues, changes in human behavior, including any lingering concerns about COVID, along with the fact that some businesses will never reopen, will all contribute to what could be a fairly lengthy recovery. Thankfully, some states and counties have been able to begin reopening in varying degrees. However, the process will be slow, with economic reopening across the nation likely to develop over a period of months. We can think of the current reopening process as proceeding somewhere along a continuum. On the one end, we have severe health concerns and toll on human lives. On the other, we have the severe economic cost of social distancing. Society is trying to find a balance and appears to be moving cautiously from addressing huge health risk toward the middle. If we get to the middle and don't overshoot, we will hasten the overall economic recovery. If whatever reopening efforts we use are unsuccessful, either because we go too fast and COVID reinvigorates with a vengeance, or we reopen too slowly and too much permanent economic damage is done, we could lengthen any hope of a quick recovery. In a worst-case scenario, it could include several years of significant economic recession. The stakes are high. The federal government's response to this crisis has been dramatic. In the past 5 weeks, more than $3 trillion in federal stimulus packages have been signed into law. To put that in context, in a little more than 1 month, the federal government committed to spend emergency stimulus equating to 11.5% of the entire nation's annual economic output. In addition to that governmental stimulus, the Federal Reserve has pumped almost $3 trillion of liquidity into financial markets through bond purchases. That amount is equivalent to 9% of the total value of U.S. GDP. Combined, the emergency fiscal and monetary support already applied to triage our national economy that is clinging on life support adds up to the equivalent of 1/5 of the U.S.'s entire annual gross domestic production. And it won't be enough. Much more support will be needed. With the economic contraction still occurring, there will be more layoffs and furloughs in the coming weeks. State and local municipalities will need significant emergency relief fairly soon, as basic services such as adequate staffing for fire, EMT, law enforcement, and refuse pickup could quickly come into jeopardy with otherwise necessary layoffs and cutbacks. The entire outlook has much uncertainty at the moment. In some ways, the U.S. government's extraordinary measures rapidly taken by necessity to date could perhaps be dubbed the Great Experiment. This massive emergency stimulus will lead to more debt issuance, which in its own way will increase the fragility of the system. But without the quick actions that were undertaken, the outlook could be very dark indeed. Key unknowns still remain. What will be the trajectory of the virus? Will it cycle back with a vengeance after initially dissipating? How bad will Main Street businesses fare? Smaller businesses are often the ones especially hurt by a sharp, protracted downturn because, on the whole, they do not tend to have access to deep capital reserves like many larger businesses do. And what will the recovery look like? We don't know, but it's looking less likely to be a V, with a pretty full recovery for most within a year. It may well not be a U, with a more sustained bottom, but then full recovery not all that far down the road. Some parts of the economy will probably recover fairly rapidly with sector reopenings. Others will very likely lag. Maybe recovery will graph more like a sharp downward line, and remember, we're not done with the decline yet, followed by a less steep and more protracted slope of recovery. Or there may be some cyclical setbacks along the way. We take the safety and welfare of our communities seriously, and we are continuously monitoring ongoing developments and safety information related to the COVID-19 outbreak. In early March, we realized our entire area would experience some difficult times as COVID-19 began to impact our state. We also realized we would need to be creative in order to serve our communities while protecting the health and well-being of each member of the CSB family. We immediately began to plan how we could best ensure a strong presence in the communities we serve during what was likely to be a major emergency that threatened the health and financial well-being of many in our area. We started with actions to assure each of our employees that the bank would take all reasonable measures to ensure the financial security and physical well-being of our employees and their household members. We immediately implemented several measures to support all CSB team members. We enhanced paid emergency time off, making COVID-related absences a covered benefit regardless of full-time or part-time status or length of service. We launched an emergency loan program available to any employee needing financial assistance due to an event caused by this health crisis. In order to comply with social distancing recommendations, we relocated about 1/6 of our workforce to different work locations or their homes. And we curtailed non-essential travel and in-person meeting activity, both inside and outside the bank's facilities. When Ohio's initial stay-at-home order was announced on March 22nd, including closures for businesses and organizations deemed non-essential, it was critically important that we quickly respond with support for our customers. That same week, we launched several loan relief programs for existing customers to allow for deferral of payments up to 120 days. These programs are for all loan types: installment, mortgage, and commercial. In the 5 weeks of offering these programs, we have provided deferral modifications to about 10% of our loan portfolio on a dollar basis. Next, we created a team to support the launch of the Small Business Administration's Emergency Paycheck Protection Program, or PPP. During the 13 days from the opening launch of the program on April 3 through April 15, when the initial round of SBA monies were depleted, we facilitated more than 450 government assistance loans. This 2-week effort placed more than $80 million in the hands of local businesses and not-for-profits in our markets. After the program ran out of its initial funding, we continued accepting applications in anticipation that a second round of PPP would become available. Round 2 reopened on Monday, April 27, and in the first 2 days this week, we've been able to lock in 172 additional PPP loans, which will provide another $12 million of emergency funds to local small businesses and organizations. We fully intend to continue doing all we can to support the businesses and residents of the communities we serve. We are committed to acting prudently for the duration of the crisis, recognizing that we must keep the bank safe and strong in order to be able to provide much-needed banking services in our communities during this time of economic peril. So this year will be challenging, to say the least. Interest rates will be low for longer, and margins will contract. Competition for banking and financial service market share keeps increasing, with growth from private equity funds, mortgage companies, and direct internet lenders. Digital customer engagement is becoming a key determinant of capturing and retaining market share. The COVID outbreak has drawn more customers to online banking options, and bots, as they're called, now perform automated tasks. Computerized intelligent analytics are being adopted by more and more financial service companies. All of these factors will be present all year and growing, and will be addressed as we all relentlessly contend with defeating COVID-19's grasp and working toward a more normalized economy. A word now on a special individual important to CSB. Director Tom Lang has retired as of this year's annual meeting, concluding 27 years of distinguished service on the board of directors. Throughout Tom's tenure, his attributes, skills, and experience in our markets have provided meaningful wisdom, oversight, and leadership expertise on the board. We are very thankful and grateful to Director Lang for his many contributions, and we wish him the absolute best as he enjoys his retirement. We close with a slide that depicts CSB from the context of who we are and what we aspire to be: a great organization serving a great marketplace. Our mission and values provide foundational definition to how we conduct our business. A strong foundation is requisite to endure. In times of crisis, it can make all the difference. We look forward to seeing you in person at the 2021 annual meeting, and we wish all shareholders well-being in the intervening year to come.